Five. George McFarland, Seven Waters Advisors, here this morning, not to talk about the eclipse, but mutual funds, huh?
That's right.
Well, you're gonna have to start off slow with me. What in the world is a mutual fund?
Well, that's a great question. So, mutual funds are a collection of stocks that are managed by a fund manager. The whole idea behind a mutual fund is that instead of you having to do all the research on each individual company that you want to invest in their stock, having to do all the trading and the active management yourself of the individual stocks, you are going to be allowing this guy to manage all the funds for you. And for a fee, his job is to try to get you as much gains as possible on your stock market investments by picking the stocks for you. So that's the basic idea behind a mutual fund.
So isn't that guy my financial advisor?
No, actually, he's so that's the financial advisor. Depends on what you're dealing with, but different kinds of investments are done by different people that call themselves financial advisors. It's a pretty general term, but most financial advisors that you may have heard about are going to be they're the ones that pick your mutual funds, but the fund manager is actually hired by that mutual fund. They're not hired by you. You purchase or buy into that mutual fund, and when you buy into that mutual fund, that fund has fees. So then usually the guys who set you up in a mutual fund are going to charge you additional fees on top of that. Well, or not, well, they won't charge you additional fees per se,
but they're looking for the funds that charge fees.
Right, and then those funds then pay them commissions,
Yes.
but those commissions are coming out of your money. So it's you're paying them fees. If you want to be super technical, you're not paying them fees, you're paying them commissions, but it's the same one way or the other.
Sure.
Okay,
so basically, correct me if I'm wrong here.
Mm-hmm.
So basically, when it comes to a mutual fund and this guy who you think is your advisor, but he's not really advising you because he's picking the ones that charge the most so he can get a little kickback off of it, he's a shady character.
No, I don't want to say they're shady, okay? I would say that maybe mutual funds are outdated and they should kind of go the way of the dodo for the most part. And over time they are, because more and more people are realizing that mutual funds are so expensive in their fees that any kind of gains that they give you just aren't really worth it when you compare it to other diversified investing models. Because that's what it is. It's about, you always hear about diversification, and that's what's championed, and diversification is important. The more stocks you have in your portfolio, and as long as those stocks don't work exactly the same way. So in other words, in one market, you may have a stock that's up and another stock that's down, but in another market, they're reversed. So you want those different types of classes of stocks kind of put together so that no matter what the market's doing, you're at least getting some gains and the losses are minimized. That's the idea behind that. But there are other products out there that do the same thing, and they're not going to cost you as much. Things like ETFs or index funds are a very good replacement for the idea of a mutual fund. Mutual funds have the highest fees out there whenever it comes to these kinds of investments. You're talking about the average mutual fund. The average mutual fund costs the investor about 3.5%. Okay, and that's super high.
Right up top.
Overall, yeah, it's so here it breaks down. The thing is, you don't know you're paying those fees. If you're listening to me right now, you're like, no way. My advisor told me I'm paying a 1% fee. Sure, that's known as your declared rate. That's what's on the paper. But every time that these funds are bought and sold, inside of that, the mutual fund managers, they have to pay a brokerage commission for trading those funds. Well, because they don't know how often they're going to trade funds inside the mutual fund, they can't declare what that rate is. So it just shows up and you're paying those fees. And then you have maintenance fees, you have all sorts of other things. Then on top of that, because the person who puts you into a mutual fund is paid off a commission, there is then and they're only going to be paid on your fund when they trade your fund for you into a different fund. There is a potential conflict of interest because in order for them to get paid, they got to put you into a different fund where you're paying another 5% commission.
Yeah, they don't want your fund just sitting there, because as long as it's just sitting there, they're not getting anything out.
They're not getting paid. That's right. So, but then you may go, oh, well, I've got one of those no load funds, which means there's no commission. Well, those funds, if you look at them, if you do the ones that have the front loaded commission, then what they're going to do, they're going to have a low maintenance fee. But if they do a no load, go check that maintenance fee and see what happens to it 4 times. So instead of paying a 5% commission up front and then a 0.5% maintenance fee, it may be a no load, but then you're paying a 2% maintenance fee. And again, this is not including any of the internal trades.
So for you, again, talking with George McFarland this morning, as we do on Fridays, Seven Waters Advisors. So for you and your experiences, do you know anybody that is thrilled to death and very satisfied and happy with their mutual funds?
Of course. Because the thing is that here, the biggest indicator of whether or not somebody has money for retirement is whether they actually invest money in retirement. So if you're consistently investing your money into your retirement and you see that your retirement account is bigger than it was before, you feel good about it. And most people, as long as their money is gaining and not losing, they feel good about it. And the fact that they don't have to really mess with it, it's kind of out of sight, out of mind, you feel good about it. So sure, there are people that feel good about the mutual funds because simply, again, when they look at the paper that they're given a paper that tells them you're only being charged 1%. And they don't know about the other charges because all they see is the gains. So your fund may have gained 12%, but as far as you know, you earned 8.
And is that, kind of what these mutual fund, what do you call them? Managers? Okay, so these mutual fund managers, is that kind of what they're banking on, is the fact that the client will never pick it apart and look at the numbers?
I mean, there's a reason why it's called a hidden fee.
Oh.
I mean, it's pretty simple. And then whenever you add it in, and we'll talk more about this next time, when you add that mutual fund inside of a 401k, and most people don't know that 401ks have fees, now you're going from 3.5% to 4.5% or more. And Mark, for their study after study shows for every percentage point that you pay, you're giving up at least 15% of your overall return for your gains throughout your investing career.
Yeah.
Meaning that if you're looking at 4%, then you're looking at 60% of your money is going to the brokerage and not to you, okay? So it's a lot of money that goes in that, again, an ETF or an index fund, you're paying 0.5%. Does that make sense?
Sure.
So those just mutual funds there are few exceptions where it's a unique class of investments where it makes more sense because there's not an ETF or an index fund for it. And they do have high potential returns. It's a good diversification. So there are times where a mutual fund makes sense, but it's rare, it's specific, and it's usually for more of your sophisticated investing, okay? For the most part, these mutual funds, now that's just the fees. That's not even including how bad they are on taxes.
That's a whole nother deal there.
That's a whole nother deal there. So here's the deal. So the taxes are not as complex whenever you're talking about mutual funds and stuff inside of a 401k, okay? And a tax deferred account. Now 401ks, again, we'll talk about that next week. They have their own set of tax issues, but a mutual fund outside of a 401k, you have to deal with something known as phantom gains. So with the mutual fund, generally on investments, you're either going to have capital gains or capital loss. Okay, so let me tell you what that means. A capital gain means that if I earned money on an investment, then that is capital gains. Pretty straightforward. So that means that if I lose money on investment, I've got capital loss. So if I have capital gains, I may have to pay taxes. And if I have capital loss, I could actually get a tax advantage, okay? Now, that being said, with a mutual fund, you would think that if your mutual fund took a loss, then you would get a tax advantage, right?
Mm-hmm.
Well, with mutual funds, you can actually lose money and still wind up paying capital gains. Because let's say you have money in a big tech stock, and you've had this money in this big tech stock for the past 30 years, but all of a sudden that particular technology starts to change or go away because of new technologies coming. And all the other people who are buying into that mutual fund start fleeing. So in order to save some money, the fund manager has to start selling some shares. So the fund sold shares, but the mutual fund overall has lost money. But because the fund sold shares, it realized gains inside of those funds, and they passed those gains through to you, even though you've lost money on the mutual fund.
Yeah.
Confusing?
There are times, and I realize that the old piggy bank gains no interest, zero interest.
Right.
It only has what you put in it.
Right.
But there are times where it's a much less headache way of doing things.
Sure. That's true, but be mindful of the fact that inflation is a guaranteed loss on any type of piggy bank.
Sure.
Right?
Sure.
So when we had 9% last year, or the year before, you're talking about your dollar lost 9%.
Right.
In value.
Right.
So when we have a 3%, your dollar has a 3% loss in value. So that means that your dollar, if you have just a 3%, your dollar loses 50% of its buying power basically every 20 years. So that's a pretty significant. So you want something that's going to at least keep pace with inflation.
Yeah. Try to at least break even. Huh?
At least break even, especially whenever you're talking about something that's just in your basic savings accounts. And you're going to have a different priority. Like, if I'm 20 years old, I should not worry about losses at all.
Yeah.
In fact, you should be excited when the stock market loses money, because if I am right now having to buy a stock for $100, okay, and all of a sudden the stock market loses 30%, now I can buy that same stock for $70. And when the stock market recovers, I got this huge gain, right?
Yeah.
So when you're young, losses aren't a big deal. As long as you keep investing, you don't get scared, as long as you got the guts to allow it to go up and down, you're good to go. Once you've built up that nest egg and you're closer to retirement, now you're going to be a little bit more, or potentially a lot more conservative. The rule is, there's something called the rule of 100. Take your age, whatever age you are, that's the amount of money that's generally going to be in a safer asset. And then the other remaining money is what's going to be in a growth asset. Because in one sense, you're not going to need the money as long, the closer you are to 100. Does that make sense?
Sure.
So you're not going to need as much gains. Does that make sense?
Right.
Okay. Now, let me throw you another thing about mutual funds.
Can't take it with you.
Can't take it with you. And listen, do you know what the average, everybody wants to leave money with their kids, and I think it's great. Legacy is important. We deal with legacy. We deal with that kind of stuff. I'm a part of Jerry Jones in my team. He is a great estate planner. We have other estate planning tools. That being said, do you know what the average, how long the average child takes to spend mom and dad's inheritance money?
6 months.
7 months, because it takes 6 months to make it through probate. I'm just joking. But it is really quick. You're right. It's about 6 months. They go right through it. That being said, circling back to mutual funds, just one other thing. On that idea of the balanced portfolio where you have 60% of your money in something safe and 40% of your money in gains, well, the guys who sell mutual funds, they're obviously going to want to continue selling you mutual funds even when those ratios start changing. So what do they offer you? They offer you a bond fund. Now, bonds are safe. That meaning if I go at a bond, really quickly, a bond is just where I give a loan to a company or a country or a state or a city. And so I give them $1,000. They give me a certain interest rate for whatever the time is. Let's say it's 10 years. I get that interest let's say it's $50 per year on a $1,000 bond. At the end of that 10 years, I get my $1,000 back. It's a loan, it's guaranteed, I'll get my money back. It's safe, right? But whenever somebody who's selling you mutual funds puts you on bonds, that's not what he's putting you into. He's putting you into where bonds are traded, and those can and do lose money. So most people don't realize this, but they think 60% of their portfolio is safe, where almost 100% of their portfolio is in the risky market. And that's what people experienced a couple years ago when both the stock market and the bond market fell. And here I'm supposed to have half of my money or more in a safe place, and all of it lost because I was misinformed about the actual safety of those funds. So a lot of people out there don't have a good balance on their portfolio. So I'm gonna pitch my RBG program real quick and we'll get off. My RBG, red, blue, green. We look at, are you properly diversified in truly safe funds, truly market-based funds, and other assets that give you a good balance? And if you're not, are you hitting those goals? And how much money do you really need to earn to reach your financial goals for income? We lay it out in a way that makes sense. I don't charge you to do it. You're welcome to come in. I'll run the report for you. And if you want to take that report back to your financial advisor, you're welcome to do it. But everybody that looks at it says this is the easiest thing for them to understand when it comes to understanding how their money works.
Very
okay?
Good. So if you have mutual funds, or even if you don't have mutual funds, but you've been thinking about it, talk to George McFarland first.
Please. My phone number is 903-445-1061. Let's at least take a quick analysis. Make sure you're not being killed on unknown, hidden, or phantom fees or taxes. And we will then help at least point you in the right direction. No cost for the RBG program. And it is literally something we can do for you every year.
And,
okay?
Get offices in Tyler and Longview, but you can meet folks in Henderson as well.
That's right. The good folks at KWRD have allowed me to have a satellite office set up right here in Henderson. I live here in Henderson, and so this is my hometown. I love working with you guys, and I really appreciate the hospitality that y'all have for me.
Very good. George McFarland, Seven Waters Advisors. Again, that phone number?
903-445-1061.
Very good. And back again next Friday morning.
Every Friday.
Very good. Thank you, George.
God bless. Bye-bye.
All right.